Welcome to Theo Trade. This is Don Kaufman. It's April 9th, 2018. You know, if you just turned on the screen, I guess, as this marketplace was closing, here we are with about 3 minutes to go to the trading day. The S&Ps are up 10. You wouldn't think much of the trading day. Nevertheless, people, we had a wild range of trade today inside of the S&P futures. I mean, for the most part, we've literally come full circle here as we come into the close. We really started the cash market today right around 26.14. And here we are with some wild sell-side activity into the close. People, the market is in trouble right now. And I'm going to show you a couple of very key levels that, again, are in play and have been in play for quite some time. Again, this marketplace in the next 2 minutes and 40 seconds, yeah, it can't close fast enough for some of the sell side activity that happens to be occurring as I speak. All right, so let's get into some of those levels and we'll kind of move forward from there, because what really matters right now is, again, kind of the broader market. For just a moment, and I mentioned this on the weekend update, for just a moment, forget about individual stocks. They're all moving in relative lockstep correlation. Again, I talked about that on the weekend video. What that effectively means is, all right, we're getting 85 to 90% correlation right now with the S&P 500. So for the most part, what it kind of means, and I'm going to keep this real simple, is there's the S&P futures. Whatever they do, pretty much so goes the market. Obviously, a few stocks are going to buck that trend from time to time. But for the most part, again, when you're getting that 85, 90% correlation, nothing matters but levels inside of the S&P futures. And I think you really have to take that into account. Now, some of the major levels we've been discussing on a day in and day out basis, and a few of them that have been hit specifically today. So to the upside here, we have this 2682. Right, so this is that 2682 right smack in the middle of your screen. 2626. That's actually where we bounced from, ripped right back to, and ripped through it. And to the downside here, and probably most importantly, and it's what I'm going to reference here, this is the 2575 level. Now that 2575 level, it is very plausible that we see this level not only get hit but possibly breached in the next day or two. This would be of, again, critical importance to the marketplace. You know, throughout the course of this trading session, as I saw the rally, you know, I really thought to myself, this rally, I'm like, oh, that makes sense. We've seen some pretty good sell side activity. I mean, again, I'll flip back to that 30-day 1 hour. All we've really done for the last 6-7 trading sessions is we just pinged back and forth between the 82 level, the 26 level. We came all the way down to the 75. That's 25.75. Ping back to the 26, back to the 75. At this point in time, again, earlier in the trading day, I figured, hey, you know what? By Tuesday, maybe we even see what, the 2682 level. Well, that is no more. And that's where I say this market is in trouble right now. If we break through this 2575, and well, for the most part, we're just going to keep right on going. And that is where I would caution many of you as the week progresses. It does start to feel like there's the closing bell. It does start to feel like markets are about to break this range. And, you know, I really shouldn't use the term, it feels like they're going to break the range. I'm going to show you specifically what I'm looking at that makes me believe that we're starting to amp up to break through the 2575. And I also want to elaborate a bit on that 2575. Let's go into the time frame here and extend from 30 days, even break this down to 180 days. And I will cruise that all the way out to like a 4-hour. Hit OK, because I just want to give you a little bit of a longer term perspective of how important this 2575 happens to be. I mean, people were going all the way back into October. We saw some of those like lows, kind of big reactionary lows in February, but it does look like we're going to be facing, again, that 2575. Now, other than just looking at the S&Ps, I never look at a marketplace autonomously. What makes me think that the marketplace is about to break through 2575? And well, I'm going to show you that. Bonds. The bonds are taken back off to the upside. So if I take the bonds back over to a daily chart, the bonds in the last two trading sessions, this looks like a much more decisive move back to the upside. And I talked about this quite a bit as well, is we saw 3 days of selling. It looks like we're about to stage a move higher. The bond is moving higher, looks like a very defensive stance, and that's defensive again against the S&Ps starting to effectively sell off. In addition to the bonds, and the bonds starting to rally back up, and they're doing some decent size out there. One thing that really struck me today on an intraday basis is that volatility, and specifically here I'm looking at the volatility futures. The volatility futures, they never really backed off. They never backed off in trade today. And for those of you, if you don't necessarily trade in an intraday basis, that's okay. But right in the neighborhood right here is the cash open. So there's the market and the cash open. And did the volatility futures back off? Mildly. They just backed off though to where they were trading throughout the course of the evening, and they never backed off. So the marketplace was rallying throughout all of this time. The S&Ps were taking off to the upside, yet the volatility never backed off. Then the volatility takes off to the upside. Obviously, the S&Ps came down, made a lot more sense. Speaking of which, today, was an incredible day for intraday traders. If you didn't trade on an intraday basis, I know some of you guys don't necessarily have time. You tune in at night and you're like, oh, I missed it. And today was some pretty strong trading. I'm actually going to show you one of the positions here momentarily, but inside of the spiders, we did a little bit of damage inside of the spiders today, and I'll show you exactly the position. So as I was saying, the volatility never really backed down today, and I want to kind of highlight a couple of aspects over here. So the volatility never backed down. That made me believe there's still pretty heavy amounts of risk in the market, but at the exact same time, the S&Ps were running. Look at this. They hit all the way to 2653 and change. So the S&Ps are running, but the volatility never backed down. And then the bonds started to stage a bit of a rally. So I think to myself, all right, the bonds are starting to stage a rally that is probably going to have an impact on the XLF, which will inversely have an impact right back to the S&Ps. So, I took a shot for it. And what did we end up doing on this position today is, again, this is a late trading session position. I didn't even open the position till 11:24. Now 11:24, all right, the markets here close at 1 o'clock. I am on Pacific time. So I took a trade with an option that literally expired, today. But I was talking about this in the weekend video. It's like, the gamma out there is spectacular, folks. And what that effectively means, I went out and risked 48 cents. All right, I didn't think it was necessarily like a really bad probability, but I went out and I risked 48 cents and closed it for a $2 limit just before recording this video here. And that was with about 9 minutes to go to the cash bell for it's over a 200% return. Again, even closer to a 300% return after transaction costs and everything. It's that's what you want to see, again, without extending yourself into extraordinary amounts of risk. So again, hit it out of the park in the spiders. Now, other positions that we've been talking about extensively lately, one of those happened to be in Tesla. On the weekend video, I updated you on this. Inside of Tesla, I built a short position. Tesla reversed today. The short position is not per se ready to be closed, but it is right on the dance floor to be closed. I've got a number of short positions inside of Tesla. Now, as I said, in days to come, what are you going to do in individual stocks? Well, we can't trade the usual suspects. We can't necessarily trade the Microsofts and the Netflix and the Apples. And the reason is, for in-out spreads, right, there's earnings coming out. And I don't want the earnings to negate some of the impact of being both bullish or bearish. But right now, markets, again, as I said, they're in trouble. And it looks like there's going to be some more sell-side activity. At this point in time, as I said, I'm not going to trade some of the usual suspects. When it comes down to Tesla, I've already got a position in there. The earnings are a little bit further out in time. Right now, okay, is a time to allow the markets to make this move. And we want to see if this blitz is going to come and take us under 25.75. Now, if we do crack solidly under the 25.75, I would look for volatility to finally really take off. You have to start to look at this for what it is. The VIX is at like what, 22? I feel like it's yawning. Like literally the VIX is yawning with the marketplace reversing big time on an intraday basis. And somewhere under 25.75, I think the VIX will finally take off to the upside. And there, people, in lies the big opportunity. What's that? It looks like we're going to flip back around from these buy-side opportunities on an intraday basis like I did in the spiders. But it looks like we're going to start to get afforded some sell-side opportunities. That is, if we crack in the S&Ps under that 25.75, I think the volatility will really start to take off inside of the broader market and provide some of our first real sell side and premium generation kind of tactics out there. Thanks everybody for joining us at TheoTrade. Have a wonderful evening. Bye-bye.